On Friday, Brent had asked a question. He said, Mike, how could I use Power Options to backtest a weekly $5 or $10 bull put credit spread on SPX with an 85 to 90 delta for the sell strike? Well, we all know Pavlov, and I'm guilty of this once in a while too. I saw the question and said, simple, let me show you, because I know the tools can do it. We set up that basic search, looking just 5 to 8 days out to expiration, looking for a minimum percentage return, minimum option bid, adjusted our strike difference, of course, to be less than or equal to 10 points for SPX spreads, and put in our short option delta of negative 0.90 to negative 0.85. And of course, we created a list for just screening against SPX positions. And we met resistance. No stock or option combinations met our search criteria. And we attempted to do different days and some basic setting changes, and still no results came up. And that's because I am a trained dog. When a question comes in, I say, absolutely, I can do that for you. I know the tools can do that for you. But once in a while, I have to go back and actually look at the question to better understand what was meant. What Brent likely meant is looking for bull put deltas that correspond to in-the-money call deltas of 0.85 to 0.90. In other words, a sell put for the bull put credit spread that's out of the money and has a delta of negative 0.15 to negative 0.10. Or in other words, looking at weekly bull put credit spreads on SPX with an 85% to 90% probability of expiring worthless. Not deep in the money put deltas of negative 0.90 to negative 0.85, which would be a bull put credit spread well above the current price of SPX, with only a 5 or 10% probability of being successful. So let's put away the bells and let's walk through creating a search correctly and using that in the historical tools. The first step is to create a search that you want to test in any strategy. Simply click the strategy you want and go into the search tool. In this case, we're going to bull put credit spreads. The first step is to click Clear Filters. Empty everything out of the parameter field that's below the listed trades. Then just set in your desired expiration time frame. Put in a minimum percent return. Put in your required delta. And remember, when using puts, we have to think in negative values. So we're looking for greater than negative 0.16 to less than negative 0.09. Or I could simply put in a probability of 85 to 91, roughly in the range that Brent was looking for. And of course, we wanted to change our strike difference to only show positions that were less than or equal to 10 points strike difference. Now, we just want to screen against a specific security. So the next step is to create a single list of a single symbol. And to do that in the parameter field, we simply go into the Lists tab. And we'll click on the button for Create/Modify Lists. This will pull up a separate window where we can see our created list. We have the ability to combine different created lists, but we're just going to click Create List, which will give us a new input to simply create a list name and put in the symbol that we want to see for this specific list. Remember, on Power Options, all indexes are preceded by the $ prefix, $NDX, $RUT, $SPX for our created list for Brent's question. Once we've saved the list, we simply select that list from the Include drop-down menu in the stock list listing. Now, our option criteria is still set from what we did, and all we have to do now is click Save. We'll save our search and call it SPX 1 week out, correct probability and delta in the description, and the strike difference that Brent was curious about. Now, you can do this for any historical test on any strategy that's supported on Power Options. You want to look for call or puts to buy with a high option volume. You can simply clear the filters, set your expiration date, set the desired option volume, minimum open interest, and the percent option volume, which is today's volume divided by the average over the last 90 days. You want to screen for high implied volatility or positions that are in the higher percent IV range. Well, clear the filters, set an expiration time frame, set your desired implied volatility, and the percent IV range where the option's IV is now compared to the life of the option. In some strategies, you'll also have IV or delta ratios. You want to see the highest maybe covered call return with a certain range in the money or out of the money. Very simple. Clear the filters, set your expiration time frame, put in your minimum return that you're looking for, 8%, 9%, 10%, and then put in your desired range in or out of the money by strikes or by percentage against the stock price. Of course, you can also filter for the highest probability. If I wanted to look for positions that were in the money, for example, in a covered call and had at least a 75, 80, or 90% probability, we would just put that in as well. This allows you, of course, to scan the entire universe of options in over 23 different strategies. But if this is about historical testing, why are we discussing creating the search first? Well, in order to run the back test and the historical testing on Power Options, we need to create the search with the parameters that we want first. Once we've done that, we can go into our desired strategy, bull put credit spreads, click on back test from the available tools, and then select the Smart History Excel, which just allows us to search across the universe of options historically based on our criteria. We simply select the date that we wish to search and the save search that we wanted to use. Let's go back to September 7th, 2021, and select our newly saved SPX 1 week out spread based on Brent's conditions. The results that come up are the trades that would have matched our criteria on that historical day at the close of market, at the end of business. We can see here the various results that we have, and the columns that are selected match what we already have set in our search tool for this strategy. And of course, at any time, we can click the Add Remove Columns button if we wanted to add other things into this field for implied volatility values, implied volatility ratios, deltas, and much more. We do already have the short option deltas selected, and based on Brent's request, all of them are between negative 0.10 to negative 0.15, probabilities above between 85.1% to roughly 90%, 89.8% on the top 8 results from September 7th, looking for the 1 week out expiration of September 13th. Once we have the results in the Smart History Excel, we can look at each individual trade to see how they performed over the expiration cycle, or we can calculate the group results. When I have my list of historical trades, we'll simply click the Edit More Information button, the blue button next to one of the specific trades, and click on Analyze Position. This will give us a minimum and maximum return for the trade over the time period of the position. Here we see the maximum was 9.9%, full profit at expiration, both puts expired worthless, and the position would have returned 9.9% against the risk. The lowest return was a loss of 15.4% of the maximum loss, and that occurred on September 10th. You'll also see graphical performances on this page for the options against the underlying security price, where the price is changed for the short put, or for the long put in this case, against changes in the stock price, and also how your percentage return on your position compared against changes in SPX and QQQ over the desired time frame. Now, calculating the group results is useful even in this type of exercise where we're looking at just one security. When I click Calculate Group Results, after we have the list of trades that would have matched our criteria historically, we see how each one performed to expiration. We can change the custom end date if we want, but this is looking at expiration day. How did all positions work out? And of the 8 positions that matched our criteria for September 7th to September 13th, we see that 8 out of 8 were successful for a 100% success rate, and the average return on the 8 positions was 8.8%. Kind of crazy 8s, huh? During that same time period, QQQ was down 1.5%, And during that same time period from 9/7 to 9/13, SPX was actually down 1.1%, but with our higher probabilities, all 8 positions would have expired worthless. Now, after that's done, we just go back into the search and we go to the next cycle to run the historical search for the next expiration series. We run the search on September 13th, and we see the expiration for September 17th. Once again, we have 8 positions that match our criteria. We click Calculate Group Results, and for that next weekly cycle of SPX bull puts with an 85 to 90% probability, short option delta of negative 0.15 to negative 0.09, another 100% success rate, average return of 10.4%, even with SPX being down minus 0.8% over that same time period. And that is how we do the historical testing with the back testing tools, the Smart History Excel and Power Options. Create your search in the live search first. You want to do that to make sure that you're seeing your desired results in the current market prices. If I wanted to run a back test for something, let's say a covered call, where the position was, the call I was selling, was 2% out of the money, but I wanted a 90% probability, well, I run that search and I'm going to get no results. There's no point in saving that search or trying to import it directly into the Smart History Excel backtest tool if I'm not searching for the right thing. So I want to create it in the live, real-time search first, make sure we're getting the proper results, then save that search, go into the backtest in Smart History Excel, and start running your tests. Pick your desired cycles. Well, you've already set that with the expiration date. Are you looking at weeklies? Are you looking at monthlies? Are you looking at quarterlies maybe? Are you looking at leaps? But select the dates that you want to start your cycles on and just run the screen to see which trades would have matched your criteria on that date. Then again, you can calculate the group results if you're looking across the universe of options and seeing different securities that match your criteria. You can even analyze the individual positions one at a time. Then keep, of course, the record of your overall returns as you go cycle by cycle by cycle. Now, after the first 2 or 3 cycles of backtesting, if you realize your targets are not being met, you're expecting an 80% win rate, but you're only seeing 60 or 65%. You're expecting an average of a 9 or 10% return, but on average, you're only seeing 2.5 or 3%. That means that the criteria you're looking for aren't meeting your goals of the strategy. You're going to have to adjust the criteria, maybe increase the probability above or below, depending on your strategy, maybe lower the return and lower the expectations to get to that higher win rate, perhaps that higher return rate with more successes instead of taking more losses by looking for something that's too aggressive in a given strategy. Now, access to the historical tools are available on our historical service, which is $100 per month. This service includes everything that's on the delayed service, but full access to the Smart History Excel for all strategies. There's a search by symbol for all strategies. So I just wanted to look up bull put credit spreads on Apple historically. I could create the searches we just walked through, or I could use the search by symbol. You also have access to the historical option chain, so you can look at the prices day by day by day on a given chain. And of course, it's also available on the premium service, which includes everything on the upper level real-time service, plus historical access and access to the API, the application programming interface. Now, the historical data goes back about 7 to 8 years, and if you're on your free trial, you get 2 months of historical data to play around with the historical option chain, the historical search by symbol tool and strategy, and of course, the historical Smart History Excel to test your potential trade criteria. Now, if you want to avoid the manual work, we do offer 2 other services that are separate prices, the strategy testing and optimization services. We use a tool in the background that we have access to plug in the criteria that you want with stops that you might consider in the strategies we have available, and we'll go ahead and run that for you. The testing service is $50 for a one-time run, and it's usually done over a few months to a 1 year time period. And we'll evaluate the results, share the results that we had with you over that time period, and of course, offer some brief analysis on how you might be able to improve those results with different criteria. The search strategy optimization is a little bit more expensive because we're going to put in extra work. On the search strategy optimization product, we'll go for a longer time frame over multiple markets, testing your criteria with your stops that you have in mind, and of course, relate to you the results. But Ernie, myself, or others will put in extra work to see how we can improve those results by changing certain criteria, adjusting potential stops that you had preferred or you had suggested to show you how we can improve those returns for the strategy that you're doing if necessary. If you're hitting your targets with the first couple of runs in the criteria to get a gauge, we'll still put the effort in, but we might not need to change much in those cases. You can use the Power Options for historical tests by just taking a free trial. You can go through the process that we just saw in any of those 23 strategies we support. You'll have access to 2 months of historical data to test against. You can search in strategy, search by symbol, or use the historical option chain. You can just go to PowerOp.com, no credit card is required, and start your free trial. Now you can subscribe to the historical or premium service if you're currently on the end of day, or the delayed service, or the real-time service. That'll give you 7 to 8 years of historical data to test. Again, search in strategy by criteria, by symbol in a given strategy using the search by symbol historical tool, or using the historical option chain. And of course, you can check out the products tab to see more detailed information on the strategy testing service we just mentioned, or the search strategy optimization. Now, do you want to see some historical results? Or bear and bowl with me for another 10 minutes, and let's see how Brent's test worked for the criteria that he wanted. Using that strategy testing service, we took our SPX 1 week out search that we just created, looking for those spreads with the 85 to 90% probability of expiring worthless, 10 strikes or less. Delta, of course, of negative 0.19 on the sold put. I'm sorry, negative 0.15 on the sold put to negative 0.09. And we're going to go week by week, just looking at SPX. Now, we started off in our strategy testing just allocating $2,000 to only the top trade of SPX sorted by highest return. These typically ended up being the 5-point spreads as we expected. They typically have a higher percentage return, not necessarily the higher net credit, but the higher percentage return opposed to the 10-point spreads. We search on Monday for the following Friday. And of course, yes, if you're interested in the new series of Monday, Wednesday, and Friday expirations, you could adjust your criteria instead of looking, say, 4 to 7 days out in time when you ran your search. You could say 0 to 3 days or 0 to 2 days. So if you ran it on Monday, you'd see the Wednesday. If you ran it on Wednesday, you'd see the Friday, and so forth if you wanted to do the 3 cycles. Now, we are going to put in a stop that if SPX hits the sold put strike price, we're going to liquidate the spread before the losses gets too big. We started on September 3rd. However, since the market was closed on Monday, September 6th, the first search that we found was on September 13th. And the results for just this weekly 85 to 90% probability bull put spreads on SPX was pretty impressive. We started off with $2,000. After the course of roughly 8 weeks, the ending cash on hand was $3,565, or 78.3% return. Now, the largest drawdown, the one loss that was taken, it was an 88% success rate, but the one loss that was taken took the account down from $2,560 after the first 2 cycles down to about $1,775. It was a total of a 41% drawdown, but from the $2,000 we started with, it was much smaller. Remember, we had taken in a few wins, so the account value had gone up from $2,000 to $2,560. As we'd expect, over 8 weeks, 8 total trades, 7 wins, 1 loss. That's our 88% success rate. The average return on the winners was 16.1%, and the average return on the loss was 38.9%, around that 40% we mentioned. Very quick, the individual trades. Trade date, September 13th, historically, SPX was at 4,468.73 cents. The top spread that matched was the 4395 sell put and the 4390 buy put, 50-cent net credit for an expected 11.1% return. SPX closed at expiration the 17th, of course, 4 days later, Monday to Friday, at 4,432.99. So both our puts expired worthless. With our $2,000 allocation, we were able to trade 4 contracts at 50 cents, so we gained $200 or 11.1%. Run the search again on September 20th, the following Monday, for the September 25th expiration. SPX is at 4357. Spread that came up was the 4,260 sell put by the 4255, a 5-point spread again. But this was 90 cents as implied volatility was increasing, or a 22% potential return. On Friday's expiration, SPX closed at 4455, about 200 points above our 4260 sold put strike. Spread would have expired, and we would have made $450. We were now able to trade 5 contracts for the 90-cent credit, so we took in $450. September 27th, SPX at 4443 for the October 1st expiration. Would have sold the 4,370 put, bought the 4,365, 50-cent net credit for another 11.1% potential return. The next day, SPX dropped down to $4,352.63. We would have closed the spread because our stop was hit. The underlying SPX was below our short put strike price of 4,370, so we closed the position at that time and took a 38.9% loss, or $875 to liquidate the position. Then we go back in October 4th. We've got another 90-cent net credit with a 4205, 4200. That expired worthless. SPX ended at 4391. And we took in $270. Success again on October 11th, $425. The 5 contracts at 85 cents, a 20.5% return. Volatility calms down, so back on October 18th, we're back to the 50-cent net credit, 11.1% return. Does expire worthless. We're increasing our value with the successful trades. We're getting back into profit zone, so we're trading 5 contracts now. That's why we have $250 instead of $200 on the 50-cent spread. And by October 25th, another 50-cent spread at the top of the list, 11.1%. We make $300 as SPX closed at 4605, and we would have done the 4505, 4500 spread. Remained out of the money, but because of the increased value in the portfolio, we were able to do 6 contracts at this 5-point spread. November 1st, the last cycle, to roughly November 5th expiration, when Brent asked his question during the Friday session. SPX on November 1st is at 4613. We would have likely sold the 4545 and bought the 4540 spread. 65-cent net credit. It expired worthless. We could do 6 contracts again, so we took in a total of $390. And that's how the account made up to $3,565 from the 2,000 starting point. 88% win rate, with a large loss, relatively, on the one cycle from September 27th to October 1st. Now, although you may have seen webinars from us on 8 ways to manage a bull put spread and trigger points, should we have held on to the loser or managed it? Well, when you're doing these weekly options, you have too short of a time to really manage the position. Maybe you could have rolled out the next week, but the stock's moving in the wrong direction for the sentiment of the trade that we're in. When you're trading weekly options, once the trigger is hit, you really want to close it and get out, hopefully with less than a 50% of the maximum loss. And that's why we always recommend that 1% stop near the short put, or if the position's at 50% of the maximum loss you could occur on the position. The next day, that's when the trigger was hit. The yellow line here is our sold put strike price On that day, it was the 43.70 for that cycle to October 1st. We would have opened it on the 27th. On the 28th, it dropped below it. We would have closed the position for a 38.9% loss. Now, the following day on September 29th, it came up a little bit, but the loss was about the same. It would have been about a 38.5% loss at the end of the day, about the same during the day, maybe a little bit better as it crept back up above 43.80. But then the very next day, you're at an 86.87% loss. What does that mean? We started with 2000. We had two successful cycles, roughly, of $200 profit on the first cycle, $450 on the next. We were roughly up to about $2,650. Now, if we had taken some of those profits, invested $2,500, and allowed it to go to September 30th, hoping it would recover, an 86.9% loss would have been $2,172 of that $25 we had in. This only leaves us with $327 or so. I can't continue to trade SPX. I need $500 minimum to trade one 5-point spread. I don't have it. I can't continue trading. I have to move to SPY or borrow money from another portion of my account to continue trading. Even if you only kept the $2,000, even though you're gaining profits on those first two cycles, you're not reinvesting it into the spread positions. That still would have been a loss of $1,738 if we held it to the 30th and realized that almost 87% loss. Again, this only would have left us with $262 left. I can't do any more trades on SPX because I need $500. I either have to move to SPY with 1 or 2 point spreads, or I have to borrow more money from another portion of my portfolio on what looks right now a strategy that's losing. And of course, if I held it all the way to the end, I would have had 100% loss on the $2,000 or the $2,500 I invested. Can't continue this strategy without taking more allocation from the remainder of my portfolio to continue the trades. That was sorted by highest return. Let's flip it. Instead of sorting it by the highest potential return, an average of 16.5, 16.6% we saw for one trade over that 8-week cycle, if we flip the sort and sort it by highest probability, we still get a successful trading record, but it's as we expect. 7 wins and 1 losses over 8 trades, but we took the $2,000 just up to $2,650, still a 32.5% return on the $2,000 we started off with. As we'd expect, since we're looking for the higher probability positions, we're going to have a lower average return rate. Drops from 16.5% down to 11.9%. We still had the 1 loss, but it was a little bit less because we were further out of the money, looking for the higher probability and the lower return, rather than the higher return and maybe only the 85% probability as opposed to an 89 or 90. And that 1 loss, of course, was still dependent on closing the position, 35.9%, when the stock breached the short put strike price. We didn't hold it to the end, otherwise we would have suffered 100% loss, just as we did in the other example. Now, before it comes up in the comments or later discussion, which are always welcome on our YouTube videos and everywhere else, how would the weekly bull put default that we advocate and discuss on Power Options have done over the same time frame with the exact same criteria and allocation and the same stop? Well, we use a strategy testing tool. We take our weekly bull puts default search. We run the search on every Monday, even though these are looking for 14 days out in time as opposed to 7. We use the same date range, September 3rd, 2021 to November 6th. Only open 1 trade. This is not our normal approach for the bull put credit spreads, but apples to apples here. And what do we end up with? We only made 5 trades over those 8-week period. And that's because, number 1, we're looking for 2 weeks out in time instead of 1. Also, there are other filters in the bull put weekly default looking for stocks in an uptrend and positive MACD. There was 1 cycle where no trades were found that matched the criteria because many stocks were below their 20-day moving average with that fall that we saw on SPX that caused the loss in the SPX weeklies. so a trade wasn't entered. But we did enter 5 trades over the 8-week period with this structure, looking at only one trade. The average return was 18.8%. We had no losses, and the ending cash on hand was $4,588, or roughly 129% return over that 8-week period. And for a complete comparison, let's take that same weekly bull put default screen again, same time frames allocation, but this time sort it by probability rather than return as it's normally done. And as we'd expect, we end up with the same win-loss ratio. Only 5 trades were made that matched the criteria over that 8-week period. All 5 of them were successful. But as we'd expect, because we went with the higher probability, which equates to a lower return, even though they still matched all the criteria we would look for, the average return is cut in half from 18.8% down to only 9.1%. But the $2,000 still went up to an ending cash on hand amount of $3,000, or a cumulative return of 50% over the 8-week period. So again, we're successful with the weekly SPX bull put credit spreads, proper delta of negative 0.16 to negative 0.09 for what Brent had asked, or an 85 to 90% or so probability above. It was successful also with switching over to sort by probability. Further out of the money, lower return. But the default weekly pull put with the same allocation, looking again just at one trade, which is not how we would approach it with allocation in this case, or just using one trade as well, did outperform, did not have any losses, and one of those benefits was that certain trades weren't entered during that decline that we saw in SPX from September 28th to October 1st, because no stocks that were trading above their 20-day moving average and had the positive MACD we look for in the default weekly bull put search matched the other return and probability criteria. So there was a cycle that was missed, and we're also looking 14 days out in time instead of only 7 or 5 days out in time. So it's not really apples to apples, but I knew someone would ask how did the weekly bull puts do over the same time period for those SPX ones, and we wanted to share that. 1 week out, bull put credit spreads, SPX, 85 to 90% probability, with short option delta between negative 0.15 to negative 0.09. 7 wins and 1 loss over a 8-week period for an 88% success rate, 78.3% return. Average return on the winners, 16.1%. Average loss on that one loser was almost minus 40%. That same SPX week out criteria, sorted by highest probability rather than highest return, still successful, but a lower ending rate of 32.5%. Still the 88% win rate, but the average on the winners naturally dropped from 16.1 to 11.9, and the average return on the losses was slightly lower at 35.9% for the one losing trade that was closed on September 28th. Thankfully, before it went to a much larger loss where we wouldn't have been able to continue this trading strategy. And again, the default weekly bull put with just allocating $2,000, just entering the top trade by return, using the same stops, compounding, meaning that every time we got a win, we might go up to 6 contracts on the next trade, 7 contracts, and so forth, based on our account value. That went from $2,000 to $4,588, at roughly 129% return on the low starting basis of only $2,000, and the average return on the wins was 18.8%. And then again, compared to flipping the bull put weekly and sorting it by probability rather than by highest return, same $2,000 starting basis, only looking at one trade, ends up with a 50% return, 5 wins, no losses, but as we'd expect, when we go for the higher probability, we take down the average return for the win. Still 9.1%, fairly respectable, but it is at the lower range of what we'd expect to see in these scenarios. Disclaimer. This was an exercise that was put together based on Brent's question that we didn't get to show very well on Friday's webinar because I saw the numbers and I said, yes, we can do that. Ring the bell there, Brent, and I'll show you how to use the tools. Didn't take that extra thought to realize he was looking for something different. Past testing results are no guarantee of future performance. These test results shown in this presentation were based on questions posed to us, and they reflect just a small time frame, just under 8 weeks, in recent market conditions. Always remember with spread trading in this case, that one loss on SPX could have easily gone to an 87 or near 100% loss. We always advocate you can never allow yourself to take more than a 50% loss on a spread trade if possible. And we saw why, because it essentially takes you out of the game where you can't continue to trade. Spread trading requires discipline, a trading plan and exit strategy, proper stops, and these can result in large losses even when looking at an 85, 90% probability, even something as stable as SPX, SPY, or NDX. Options trading does involve risk, and it may not be suitable for all investors.